The gold market just delivered one of the strongest signals we've seen in years. While most investors are watching price charts, the world's biggest gold buyer quietly accumulated another 173 tons of physical gold. This isn't speculation, it's a strategic move that could reshape the future of precious metals. The real question isn't who bought the gold. The real question is what do they know that the rest of the market doesn't? Today, we'll break down the hidden message behind this massive purchase, why central banks continue accumulating gold at record levels, and what David Morgan believes could happen next. The latest wave of gold buying has captured the attention of financial markets around the world, and for good reason. A purchase of 173 tons of physical gold is not the kind of event that happens quietly in the background without carrying important implications. While headlines often focus on daily price movements or short-term volatility, transactions of this scale tell a much deeper story. They reveal how major institutions, governments, and long-term strategic investors are positioning themselves for the years ahead rather than the next few trading sessions. When an entity accumulates this much physical metal, it isn't making a speculative trade. It is making a statement about confidence, risk, and the future of the global financial system. Gold has always occupied a unique position in the world economy. Unlike currencies, it cannot be created by a central bank with a policy decision. Unlike stocks, it is not dependent on corporate earnings. Unlike government bonds, it carries no promise from any government to maintain its value. Its appeal comes from scarcity, durability, and centuries of recognition as a store of wealth. Because of these characteristics, large-scale gold purchases often serve as signals rather than isolated investment decisions. A transaction involving 173 tons immediately raises several questions. Why now? Why such a significant amount? And perhaps most importantly, what expectations are driving this decision? Institutions that acquire gold on this scale typically conduct extensive research into economic trends, monetary policy, geopolitical developments, and long-term financial risks. Their decisions are usually based on years of planning rather than weeks of market excitement. One of the most important aspects of this purchase is its physical nature. Physical gold differs fundamentally from paper-based investment products. Exchange-traded products, futures contracts, and other financial instruments can provide price exposure, but they do not always represent immediate ownership of allocated metal. Physical bullion removes many layers of counterparty risk. It represents direct ownership of a tangible asset that exists independently of financial institutions. This distinction becomes especially relevant during periods of economic uncertainty. Throughout history, episodes of financial stress have reminded investors that liquidity and ownership are not always the same thing. Markets can experience disruptions, counterparties can fail, and confidence can deteriorate rapidly. Physical gold has historically been valued because it remains outside many of those risks. The timing of large gold acquisitions often reflects broader concerns about the global economy. Inflation may have eased from previous peaks in some regions, but uncertainty surrounding long-term purchasing power remains. Governments continue to manage high debt levels, interest rate expectations continue to shift, and geopolitical tensions remain elevated across multiple regions. These factors encourage institutions to diversify reserve assets and reduce dependence on any single currency. Central banks have become increasingly active participants in the gold market over recent years. Their accumulation trends suggest a gradual reassessment of reserve management strategies. Rather than relying overwhelmingly on foreign currencies, many have expanded their holdings of physical bullion. This diversification reflects a desire for assets that are internationally recognized and not directly tied to another country's fiscal or monetary decisions. A purchase of 173 tons reinforces the perception that gold continues to play an essential role in long-term financial planning. Such buying is not driven by daily headlines or short-lived market sentiment. Instead, it reflects a strategic outlook that extends well beyond the current economic cycle. Another reason this development deserves attention is the relatively limited growth in global gold supply. Mining production increases only gradually. Discovering new deposits is becoming more difficult, environmental regulations are stricter, and developing new mines often requires many years of investment before production begins. As a result, substantial increases in demand cannot always be matched by equally rapid increases in supply. When demand rises significantly while supply remains constrained, markets can experience prolonged periods of adjustment. Prices are influenced by numerous factors, but the balance between available physical metal and long-term demand remains one of the most important fundamentals. Investor psychology also plays a significant role. Large institutional purchases often influence market expectations because they are interpreted as informed decisions. Retail investors may wonder whether these buyers possess insights unavailable to the public. While no institution can predict the future with certainty, their actions frequently reflect extensive analysis of economic conditions. Confidence is one of the most valuable assets in any financial system. Currencies derive much of their value from public confidence in the institutions that issue them. Financial markets rely on confidence that contracts will be honored and obligations fulfilled. Gold occupies a unique position because its value does not depend on the financial strength of a particular government or corporation. Periods of rising geopolitical uncertainty often reinforce this characteristic. International tensions, trade disputes, sanctions, and regional conflicts create incentives for reserve diversification. Physical gold provides an internationally accepted asset that can serve as a financial stabilizer regardless of political developments. The broader investment landscape has also become increasingly complex. Equity markets remain influenced by changing earnings expectations. Bond markets continue to respond to interest rate adjustments, and currency markets are shaped by shifting monetary policies. Against this backdrop, many institutions seek assets that provide diversification rather than direct correlation with traditional financial instruments. Gold's historical role as a portfolio diversifier contributes to its appeal. While its price can fluctuate over shorter periods, its long-term relationship with other major asset classes has often provided valuable balance during episodes of financial stress. The scale of a 173-ton purchase also highlights the logistical realities of the bullion market. Acquiring such quantities requires careful planning, secure transportation, verified storage, and coordination across multiple participants. These are not impulsive transactions. They involve substantial operational preparation and financial commitment. Another important consideration is liquidity. Gold remains one of the most actively traded commodities in the world, with deep global markets operating across major financial centers. This liquidity allows institutions to hold significant positions while maintaining confidence that the asset can be bought or sold when necessary. Market participants frequently distinguish between speculative trading and strategic accumulation. Speculative trading focuses on shorter-term price movements, whereas strategic accumulation prioritizes long-term wealth preservation and reserve management. A purchase of this magnitude falls firmly into the latter category. It is also important to recognize that official gold buying can influence market sentiment without immediately producing dramatic price movements. Prices are determined by a combination of futures activity, physical demand, investor expectations, currency movements, interest rates, and broader macroeconomic conditions. Large purchases contribute to these dynamics but do not operate in isolation. For long-term observers of precious metals, developments like this reinforce an enduring principle. The most significant signals often emerge from actions rather than words. Public commentary may change from month to month, but reserve allocation decisions reveal where institutions are committing substantial financial resources. This event also encourages investors to reconsider the difference between market noise and structural trends. Daily fluctuations attract headlines, yet structural shifts unfold over years. Sustained institutional demand, evolving reserve strategies, constrained mine supply, and ongoing geopolitical uncertainty represent long-term forces that can shape the market well beyond any single news cycle. Viewed in this broader context, the acquisition of 173 tons becomes more than an impressive statistic. It reflects strategic positioning in an environment characterized by economic uncertainty, evolving monetary policy, and changing global financial relationships. Whether one views gold primarily as a hedge, a reserve asset, or a portfolio diversifier, transactions of this magnitude demonstrate that major market participants continue to assign significant value to physical bullion as part of their long-term financial strategy. The latest surge in institutional gold buying has prompted a fundamental question that extends far beyond the daily movement of prices. Who is buying so much gold, and what motivates these massive purchases? The answer is far more complex than simply saying that investors are becoming optimistic about precious metals. The buyers participating in today's gold market represent a diverse group of institutions, each with different objectives, different investment horizons, and different assessments of global financial risk. Understanding who these buyers are provides valuable insight into the forces shaping the modern gold market. At the center of this trend are central banks. Unlike private investors, central banks do not purchase gold to maximize quarterly returns or speculate on short-term price fluctuations. Their role is to manage national reserves, maintain confidence in monetary systems, and preserve financial stability during periods of uncertainty. Because of these responsibilities, their investment decisions are generally based on strategic considerations that can extend decades into the future. Over recent years, official gold reserves have increased across numerous countries. This accumulation reflects a growing emphasis on diversification. Many reserve managers have traditionally allocated significant portions of their holdings to foreign currencies and government bonds. While those assets continue to play an important role, recent economic developments have highlighted the value of maintaining reserves that are not directly tied to another country's monetary policy or fiscal position. Gold offers characteristics that few financial assets can match. It carries no credit risk because it is not someone else's liability. It cannot be created through monetary expansion. It has a long history of maintaining purchasing power over extended periods. These qualities make it attractive to institutions seeking resilience rather than maximum yield. Another important group of buyers includes sovereign wealth funds. These organizations manage national wealth generated from natural resources, trade surpluses, or other long-term revenue sources. Their investment horizons often span generations rather than economic cycles. For these institutions, gold can serve as a strategic allocation that balances exposure across equities, fixed income, infrastructure, and alternative assets. Large commercial banks also participate in precious metals markets, although their objectives vary. Some act as market makers, facilitating transactions for clients. Others maintain positions to support trading operations or hedge financial exposure. Their activity contributes to overall liquidity and helps connect institutional demand with global supply. Private investment firms have also expanded their interest in physical bullion. Asset managers responsible for pension funds, insurance portfolios, and diversified investment strategies increasingly view gold as a portfolio stabilizer. Rather than replacing traditional investments, gold is often incorporated to improve resilience during periods of heightened volatility. Family offices managing substantial private wealth represent another significant source of demand. Unlike many institutional investors bound by quarterly reporting cycles, family offices frequently adopt multi-generational perspectives. Wealth preservation often takes priority over aggressive growth, making physical gold an appealing component of long-term financial planning. High net worth individuals have likewise increased allocations to precious metals. Many have experienced multiple economic cycles and understand that financial markets rarely move in straight lines. Diversification across different asset classes, including tangible assets such as gold, reflects an effort to reduce concentration risk. Industrial demand also contributes to the overall picture, although it represents a smaller portion of total consumption compared with investment and jewelry. Gold's unique physical properties make it valuable in electronics, aerospace, medical equipment, and specialized manufacturing. While industrial demand alone does not explain record purchases, it reinforces the metal's broad economic importance. Jewelry demand continues to play a major role in many regions. In countries where gold ownership has deep cultural and financial significance, jewelry functions as both adornment and long-term savings. Families often purchase gold during weddings, religious celebrations, and important life events, creating consistent demand regardless of short-term market sentiment. Regional differences further illustrate the complexity of global demand. In some economies, gold ownership is viewed primarily as an investment. In others, it serves as a traditional form of household wealth that can be passed between generations. These cultural factors create demand patterns that differ substantially from those observed in purely financial markets. One of the strongest motivations behind institutional buying is uncertainty surrounding the global economy. Inflation expectations, public debt levels, geopolitical tensions, trade disputes, and changing monetary policies all influence reserve management decisions. Institutions recognize that uncertainty cannot be eliminated, but exposure to it can be managed through diversification. Currency diversification has become an increasingly important consideration. International reserves historically concentrated heavily in a limited number of reserve currencies. While these currencies remain essential to global commerce, some institutions seek broader diversification to reduce dependence on any single monetary system. Gold provides an internationally recognized reserve asset that exists outside the liabilities of individual governments. Interest rate expectations also influence demand. Higher interest rates can affect the opportunity cost of holding non-yielding assets such as gold. However, institutions often evaluate real interest rates rather than nominal rates. When inflation reduces the purchasing power of fixed income returns, gold may remain attractive despite higher headline interest rates. Geopolitical developments have reinforced this perspective. Trade restrictions, financial sanctions, and international disputes have encouraged some reserve managers to reassess the composition of their assets. Gold's independence from specific financial systems enhances its appeal during periods of geopolitical uncertainty. Supply dynamics further strengthen institutional interest. Gold production cannot be expanded rapidly in response to rising demand. Developing new mining projects requires extensive exploration, environmental approvals, infrastructure investment, and years of construction. Even after discovery, bringing a major deposit into production is a lengthy process. Because supply growth tends to remain relatively modest, sustained increases in institutional demand can have lasting implications for market balance. Although prices respond to many variables, persistent structural demand influences long-term trends. Another reason institutions accumulate physical bullion is the distinction between ownership and exposure. Financial instruments linked to gold prices provide market access but may involve counterparties, intermediaries, or contractual obligations. Physical ownership removes many of these considerations and provides direct control over the asset. Storage arrangements are therefore an important aspect of institutional strategy. Reserve managers invest heavily in secure vaulting, auditing procedures, insurance, and verification processes. These measures ensure that physical holdings remain accessible, transparent, and protected. Risk management frameworks increasingly recognize the importance of assets with different return characteristics. Diversification seeks to reduce portfolio vulnerability by combining investments that respond differently to economic events. Gold has historically demonstrated behavior that differs from many conventional financial assets, making it a useful component of broader allocation strategies. Behavioral factors also influence market dynamics. When respected institutions increase their gold holdings, other market participants often pay close attention. This does not necessarily imply imitation, but large purchases can encourage investors to re-evaluate existing assumptions about economic conditions and financial risks. Media attention frequently focuses on price movements while overlooking reserve allocation decisions. Yet institutional purchases often represent stronger indicators of long-term conviction than daily market commentary. Reserve managers commit substantial resources only after extensive analysis involving economists, financial specialists, geopolitical experts, and risk professionals. Technological developments have improved transparency throughout the gold market. Enhanced reporting, refined vaulting standards, and more efficient trading infrastructure have increased confidence among institutional participants. These improvements support broader participation while maintaining the integrity of physical ownership. Environmental and governance considerations have also become increasingly important. Many institutions now evaluate mining practices, supply chain transparency, and responsible sourcing standards when acquiring bullion. Ethical procurement has become an integral part of long-term investment policies. Another factor supporting institutional demand is the recognition that economic forecasting remains inherently uncertain. Even sophisticated analytical models cannot eliminate unexpected developments. Diversification, therefore, serves as preparation for multiple potential outcomes rather than a prediction of one specific future. Historical experience continues to shape reserve management. Financial crises, inflationary periods, banking disruptions, and geopolitical conflicts have repeatedly demonstrated the importance of maintaining assets capable of preserving value under a wide range of conditions. Gold's long record contributes to its continued relevance despite the evolution of modern financial systems. International reserve composition reflects changing economic realities. As global trade patterns evolve and emerging economies increase their influence, reserve managers periodically reassess how assets are allocated. Gold frequently forms part of these reviews because it remains universally recognized across jurisdictions. The scale of recent purchases also demonstrates confidence in gold's long-term strategic role rather than expectations of immediate gains. Institutions allocating billions to physical bullion typically evaluate decades of economic history, structural trends, and macroeconomic scenarios before making significant adjustments. Ultimately, identifying who is buying the gold reveals a market driven by far more than speculative enthusiasm. Central banks, sovereign wealth funds, institutional asset managers, family offices, commercial participants, and long-term investors each contribute to demand for different reasons. Some seek diversification, others prioritize stability, many focus on preserving purchasing power, and nearly all recognize that uncertainty remains a permanent feature of the global economy. Their collective actions illustrate how gold continues to occupy a distinctive position within modern finance, not simply as a commodity, but as a strategic reserve asset, a portfolio diversifier, and a store of value recognized across markets, currencies, and generations.